and CEO, Mr. Rajan Painter, Executive Director, Mr. Niranjan Banodkar, Chief Financial Officer, Mr. Manish Jain, Country Head, Wholesale Banking, Mr. Pankaj Sharma, Chief Strategy and Transformation Officer, and Mr. Sunil Parnami, Head of Investor Relations. Mr. Prashant Kumar will give an overview of the results, which will be followed by a question and answer session. As a reminder, all participant lines will be in the listen-only mode. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashant Kumar. Thank you, and over to you, sir.
A very good morning, and thank you for joining us so early in the day for our Q4 and full year FY24 earnings calls. On this call, I am accompanied by the senior team members of the bank. Moving straight on to the results, as a bank, last fiscal, we continue to make consistent improvements across all the core operating metrics and progress well on the key strategic objectives of improving the profitability of the bank. As I take you through the key highlights of the financial performance across deposits and loan growth, NII and NIM, fee income, asset quality and provisioning, profitability, and lastly, but importantly, of the progress made towards shortfall in the PSL subcategories. You may also refer page number 6 to 14 of our investor presentation to get more detailed insights as to how the bank is working on each of the key business levers. But fundamentally, the key for us has been and would continue to be the disciplined execution towards the fulfillment of the stated objectives. Moving on to the key performance highlights, fiscal 24 marks the third straight year of full year profitability for the bank since the year of reconstruction. This is yet another important milestone, particularly in the context of eligibility of the bank towards empanelment for government and PSU businesses. Bank reported FY24 net profit at 1,251 crores, which is up by 74.4% YOY. Bank ended the year with Q4 24 ROA at 0.5%, against 0.2 in Q3 and Q4 FY23. And this is despite incremental PSLC related costs and stepping up the PCR. Full year FY24 net interest margin came in at 2.4% against 2.6 in fiscal 23 due to negative drag because of the RIDF deposit placed for the PSL shortfall, which has further marginally inched up and now peaked at 11% of our total assets compared to 9% in March 23. This increase is due to calls related to prior period shortfall. However, in line with our guidance, in fiscal 24 itself, the bank has made substantial progress on PSL compliance, and I am pleased to share that from here on, bank would start seeing a gradual reduction in these balances. The bank has concluded fiscal 24 with nil shortfall in the overall PSL and subcategories of small and marginal farmer and weaker section. Further, the shortfall in the non-corporate farmer subcategory has been brought down to around 1.4%. This was done through a combination of organic accretion as well as through purchasing of PSLC. As a result, beginning fiscal 25 at an overall level, we would start seeing a reduction in the RIDF balances, and bank expects that gradually and by the end of fiscal 27, these balances would eventually further reduce to below 5% of our total assets, bringing it much closer to the average level, similar to that of some of our other large private sector bank peers. With that, bank would also start seeing a reduction in its negative drag on our margins and profitability. Sequentially, NIM for Q4 was flat at 2.4, with net spread marginally improving by 2 basis points compared to Q3. Net interest income for the quarter at 2,153 crores was up 2.3% YOY and 6.8% sequentially. As regards non-interest income, bank saw strong momentum sustained across all diverse and granular fee income streams. In fiscal 24, non-net interest income has grown by 39% YOY to 5,114 crores. Over the last 2 years, the bank has seen a meaningful increase in its fee to average asset, which has increased from 1.1% in FY22 to 1.3% in FY24. Within non-interest income, the share of retail fee has increased from 55% to 66% over the same period. The sustained momentum in our fee income was driven by strong traction in third-party fees and continuing traction in other fee lines such as trade and remittance, interchange, and cash management. This momentum is expected to continue, driven by our strong customer acquisition engine, which is very well integrated with our spectrum banking and relationship banking channels. Our distinctive mode in our payments, APIs, and digital and transaction banking leadership, and also our refreshed Yes Bank brand, and lastly, our service orientation and disciplined execution. Sequentially, reported non-interest income at 1,566 crores has grown by 56% YOY and 31% quarter-on-quarter. Normalizing for interest on income tax refund of 118 crores, Q4 non-interest income has grown 21% quarter-on-quarter. For fiscal 24, cost to income ratio normalized for PSLC cost and interest on income tax refund was 72.2% against 72.6% in FY23. For full year FY24, total cost of 9,824 crores included cost amounting to 377 crores incurred on purchase of PSLC certificate against nil expenses in FY23. For Q4 FY24, while on reported basis, costs were up 27% YOY. However, normalizing for PSL cost of 254 crores incurred during Q4, the YOY growth was 15.6%. The Q4 FY24 cost also included variable pay cost of 109 crores. The Q4 FY24 cost to income ratio, adjusted for PSLC costs and interest on income tax refund, was at 71.2% against 70.9% in Q3 FY24. For fiscal 24, bank reported PPOP of 3,386 crores, which has grown by 6.4% YOY. The salient highlights pertaining to asset quality, slippages, recoveries, and provisions are as follows. Compared to Q3 FY24, both the gross as well as net NPA improved 30 basis points to 1.7% and 0.6% respectively. Resolution momentum remained strong during the last quarter as well, with recoveries and upgrade of 2,092 crores during the quarter. And for full year FY24, the total recoveries of 5,978 crores in line with our guidance. Recoveries from security receipts and realization from ARC sale during the quarter were prudently utilized in further strengthening the asset quality matrices, as evidenced through more than 50% reduction in the net NPA and net carrying value of security receipts as percentage of advances to 1.1% against 2.4% in same quarter last year. Nearly half of that reduction has come in Q4 alone. NPA provision coverage ratio was stepped up to 66.6% against 56.6% last quarter and 62.3% in Q4/23. Including technical write-off, PCR now stands at 79.3% against 71.9% in Q3 and 72.3% in Q4 FY23. Non-tax provision cost for Q4 at 471 crores and for full year at 1,886 crores and as a percentage to total assets were in line with our guidance of 50 basis points. The gross slippage for Q4 was at 1,356 crores against 1,233 crores in Q3. Slippages net of recoveries and upgrade in Q4 at 370 crores against 574 crores last quarter. Retail segment gross slippage for Q4 at 977 crores has come down against 1,051 crores last quarter. Net slippage at 567 crores also has come down against 644 crores last quarter. One account in mid-corporate classified as NPA during the quarter has actually nil financial overdue. Gross slippage for FY24 at 5,334 crores. However, the slippage ratio as percentage of advances for FY24 was flat at 2.3%. Moving over to business, balance sheet and other highlights. Bank's balance sheet crossed 4 lakh crore mark, registering a YOY growth of 14%. CD ratio improved to 85.5% from 89.9% in Q3. Robust acquisition continued in deposit as it came in highest ever in the history of bank at 2.6 lakh crores, clocking a healthy growth of 22.5% YOY and 10% quarter-on-quarter. For full year and quarter ending 31st March 2024, the CASA ratio came in at 30.9% as compared to 29.7% in Q3 and 30.8% in Q4 FY23. During the year, bank added 1.7 million new CASA accounts. We remain committed to judiciously expand our distribution and added 134 new branches since January 23 in CASA-rich clusters. CASA balances at the end of Q4 were up 23% over Q4/23 and 15% over Q3 of the FY24. The average daily current account and average daily saving account balances have also grown by 12.3% and 13.5% respectively in Q4. Retail and small business deposits, as per the gross LCI definition, at 1.17 lakh crores has grown by 18% YOY. CASA plus retail TD are at 57.2% of the total deposits. As we continue to leverage branches as the fulcrum of our business, the contribution of retail and branch banking deposits increased to 53.1% of total deposits compared to 52.1% in FY23. For fiscal year 23-24, the incremental CASA ratio was 31.5% and the incremental CASA ratio in deposits sourced by our branch banking channel was even higher at 37.5%. Year-end net advances, excluding reverse repo, has grown by 13.8% YOY, aided by sustained growth momentum in SME and mid-corporate advances at 25% plus YOY and resumption of growth in corporate segment. As guided earlier, we expect that within advances, the ratio of retail plus SME segment advances to wholesale segment advances, that is the mid-corporate and large corporate, would remain at the similar level of 60-38 from here on over the near to medium term. Within advances, while we would continue to drive steadfast growth in SME and mid-corporate segments and further enhance our focus on profitability improvement within retail, we would expect corporate advances segment to grow in high single digits going forward. In Q4 FY24, the bank's average quarterly LCR remained healthy at 116.1%. Regarding capital position, while CET and capital adequacy at the year end was at 12.2 and 15.4% respectively. However, including the effect of the warrants exercise by CA Bank in the month of April 24, the pro forma CET1 as on March 31, including the proceeds from warrant conversion, worked out to 12.7%. Another highlight, Yes Bank has joined hands with Indian Olympic Association as principal sponsor for Team India for Paris Olympic 2024. This reflects our dedication and commitment to national pride and to showcase our commitment to support Team India in Paris Olympic 24. The bank also launched a special saving account proposition called Yes Glory, along with a campaign, Milkar Jitayenge. Another notable highlight was a partnership with a skilled player in payment ecosystem as a PSP payment bank, reflecting the inherent strength in the capabilities and technology infrastructure of the bank. This partnership is expected to further aid our market share in digital payment ecosystem, merchant acquisition, current account balances, and transaction banking flows, and thereby resulting in some improvement to our fee. We have also launched Yes Pay Next, a cutting-edge next-gen UPI payment app which provides a seamless, secure, and smarter way to manage transactions. Further, I am humbled to share that last quarter, Yes Bank got certified as a great place to work by GPTW Institute India and is ranked amongst the top 50 in India's best workplaces in BFSI 2024, and this is the second year in a row. Bank has also received top award for Best Bank for promoting government schemes in the private sector, and we are also named runners-up for Best MSME Bank in the private sector at MSME Banking Excellence Award 2023. Lastly, we also became the first Indian bank to conduct export finance transaction at Receivable Exchange of India Limited, an international trade finance service platform in India. I would like to conclude that as we enter the fifth year of the journey of Yes Bank of today, we remain focused on diligently executing the ROA expansion roadmap and remain absolutely resolved around our disciplined execution. We thank you for your continued support, and with this, we can now take your questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Hi, sir. Thanks a lot for the opportunity and quite good set of numbers. So there are a couple of questions I had. Firstly, with respect to margin. So with the reduction in margin, with the help of CASA and improvement in asset quality, we had a stable margin for this quarter. So how it is expected to pan out maybe in FY25, if you can help us understand that, sir?
Rakesh, margins for us, we discussed this in the past as well. There are three drivers for us on driving margins. I don't want to kind of give a very specific guidance in the really near term, but talk about a more 2 to 3 year journey. One, very emphatically, we've said that there is RIDF balances which are causing a drag on the margins, and we've also actually given a pro forma number in our presentation to say the current drag on the stock is about 70 basis points on NII to assets. So that's one. So as the balances of RIDF come down, and like Prashant mentioned in his opening remarks, we are fully compliant with the PSL requirements, even at a subcategory level in fiscal 24. There's a marginal shortfall in the NCF category, but as a consequence, we will now start seeing reductions on a year-on-year basis, and that will start flowing into the margins over the next 2 to 3 years. As I said, the total stock hit is about 70 basis points. The second point is what we are also doing is on our assets, and especially on the retail assets mix. There is also a calibration towards moving into more ROA accretive products, which also inherently give better yields. So of course, this journey that we are pivoting towards means that the growth that's incrementally coming on this book is coming at a slightly lower rate. And you would have seen retail has been growing at about 35-40%, has kind of now come into the 20s, and we should possibly see the growth taper also to let's say the teens, right? The point is, in the process of that, we will, however, see improvement from a margin standpoint. As we speak, the retail disbursements actually are clocking at a yield which is already 100 basis points more than the stock of the retail portfolio yield, right? So that is already an indication that on the margin, we are moving into better yielding products. The third is really the focus on getting the cost of funding improved through a better CASA, through making sure that you are not just putting rates on the table for accreting deposits. And again, if I just give an example, if you look at fiscal 24, and if I look at, let's say, the blended savings account rate, over the last 1 year, we would actually not have increased our blended savings account rate despite the backdrop of the tight liquidity and real struggle or difficulties that the industry has witnessed on savings account, right? So and not only that, on the incremental market share, we've actually done better on savings account, and we have numbers till December. We've actually done much more than what our stock market share is. So the focus on deposit and funding is also to make sure that relative to the market, keep improving the rate. So we don't want to just put rates for acquiring deposits. So it's a combination of all these three. There is, of course, we continue to see a reduction in our non-accruing assets, which is the NPA stock coming down. That will, of course, also add to margins. But just the first two, which is the mix of RIDF coming down, and we do see a trajectory where in the next 2 to 3 years, this should be below 5% of our total assets. And the retail assets mix, both of these we believe will add to about 80 to 100 basis points of margins for the next 3-year period.
Great. So just to understand this CASA progression in this quarter, so if we have to build this number to FY25, so what is the sticky part? What is the one-off part? If you can help us get some clarity.
So Rakesh, what happens is we do see some transient flows that do happen in March, and it is, to be honest, it is not peculiar to only this March. It is peculiar to almost every year end that go through, because there are also businesses who like to maintain cash for their year end transactions. They also demonstrate good amount of sales that kind of come through. This year was also a little bit peculiar because there were also holidays. There was weekend that kind of coincided. Some of our fintech partners also end up keeping certain balances on in excess to make sure that there is absolutely seamless flow of transactions. So look, you could possibly look at let's say a 5% adjustment to the number, but to be honest, as I said, the peculiarity of the CASA balances do continue mostly all year ends.
Got it. Thank you, sir. Thanks a lot.
Thank you very much.
Thank you. The next question is from the line of Jai Mundra from ICICI Securities. Please go ahead.
Yeah, hi, good morning, sir, and thanks for the detailed presentation, which you keep on adding relevant disclosures. So thanks for that. I have 2 questions on. First on recovery, sir. So last year we had set out a target of 5,000 crore, and we very well achieved that. In your assessment, how should one look at recovery quantum for FY25?
So Jay, this year we have done the recoveries and upgradation to almost like 6,000 crores, and we are quite confident that FY25 also we will see a similar trend, but definitely more than 5,000 crores.
Great, sir. So, sir, just to understand, so hypothetically, let's say we achieve 6,000 crores of recovery, right? If I look at our current net NPA plus, unprovided security receipts, that is like 1.1%, right? So that would mean that the excess of that would flow into negative provision. So you may have a negative provisioning for full year FY25. Is that the right understanding?
No, absolutely. Like if you see the current net NPA, net carrying value of SR is 1.1%. Okay. And when we are talking of recoveries, the first thing, the recoveries also include the upgradation, right?
Right.
But in terms of recoveries and the write back of provisions, would be definitely there.
Right.
The credit cost will also take into account slippages that we will have for next year and the consequent provisioning of that. Like we've mentioned, we do believe that every time we get recoveries and recoveries are in excess, we keep strengthening the balance sheet. So in terms of a prioritization, we will make sure that our SR book is completely off. So currently our the carrying value of our SR book is about 50 basis points. The redemption that will come through in fiscal 25 will make sure that balance becomes zero by the end of fiscal 25, right? That's the first priority. The second is that the NNPA that we have in our books, which is currently at 60 basis points, adjusted for the slippages that we will have next year, we will want the PCR also to actually go past 70 basis points, 70%, right? I think that's the broad endeavor that we have to say how can we further take the PCR in excess of 70 basis points. Although, to be honest, the recovery rates that we do exhibit on our existing portfolio are actually much better than, let's say, a loss rate of 70%. But, I think it's just prudent to keep that, right? So both of these, if we add, adjusted for the recoveries that we'll get from SRs, we do believe that the non-tax provisioning that we will end up for fiscal 25 should again be contained, below 50 basis points. Of course, the more recoveries we get, it kind of plays into the P&L. But at least there is an endeavor to keep further strengthening the quality of our balance sheet. And just to clarify, when I say sub 50 basis points of non-tax provisioning, it is to average assets, just for abundant clarity.
Understood. And Ranjan, how should one look at the slippages? I mean, earlier 1-2 quarters back, we had some slight uptick in the retail slippages. Now this quarter and full year basis, it is more or less, 5,000 odd crores of the total slippages that we have seen. How should one think of the slippages for next year?
So Jay, if you recall again, last year we did indicate that we would operate the slippages between a 2 to 2.5% range. That was the broad range, and the range was slightly wider given the fact that we were seeing some early signs on the retail portfolio. I think what we are kind of pleased to report is that while the retail slippages did go up during fiscal 25, but we are already seeing now signs of that settling as we exit fiscal 24, right? So on a blended basis this year, we did have a slippage ratio on the average loan book at about 2.4%. We do believe that for next year, the slippage ratio should be on the lower end of the 2 to 2.5%. I think that's really how we see. It might not come off immediately, but I think we are seeing H1 should be closer to the higher range of higher side of the range of 2 to 2.4. But as we exit, we should start moving into the 2% or below slippage rate.
Right. Yeah. And in Prashant sir, in your opening remarks, you mentioned something around that, something related to asset quality in mid-corporate. I actually missed that comment. If you could please repeat that. I think you said something related to slippages or asset quality in the mid-corporate segment.
Yeah. So during the quarter, we had one account slip into NPA from our mid-corporate segment. So this was actually an account in the road. It's a road project where because there is a date of commencement of commercial operations. If you don't meet that, then you slip into NPA. So this is a largely completed road project. In fact, there is no delinquency on this particular account, but it's just that because it crossed the date, it had to be classified as an NPA. So that was just one call out that we wanted to make in the mid-corporate segment.
Right. And then last question. So we have given a very good numbers, disclosure in terms of normalized, what would be normalized P&L, assuming the PSL or RIDF drag settles. But in your assessment, the way PSL will work or the PSL requirement will keep coming down on incremental basis. But how should one look at the FY25-26 ROA progression from current levels onwards, considering the RIDF or PSL, they will not go away straight away. They will go away only maybe 3 years time out. So in the intermediate term, how should one look at blended ROA? Thank you.
So Jay, we've actually, as I said, we've not given a very specific guidance in the near term. We kind of refrain from speaking about that. But the trajectory that we maintain from an ROA perspective is an improving ROA. And we've again, I'm happy to kind of take you through again on the 2 to 3 year roadmap that we have, which largely includes that our NII to assets should actually expand quite materially for the reasons that I mentioned. There will be some room for improvement on non-interest income for us. So we currently operate at about, let's say, full year will be about 1.3%. We do believe that over the next 2 to 3 years, we will see about 8-10 basis points of accretion, let's say, typically every year. On operating expenses, despite the PSLC, we've been calling out that our operating expenses to assets should be contained in the range of about 2.6-2.7%. In fact, we have said it should be below 2.6. However, adjusted for PSLCs, we might end up at about 2.65 or something. We do believe that we should operate at sub 2.6%. There are certain initiatives that we're also playing out on the operating expenses. We think there is a room of about 10 to 15 basis points over the next 2-3 years. All of that, I would say from an ROA perspective over the next 2 to 3 years, it's all flowing in materially from the NII. As I mentioned right at the start, it's about 80 to 100 basis points that we do see flowing into the ROA ultimately. Right.
Thank you. And sorry, last clarification, the PSL, we are compliant on overall as well as sub-segment basis in all sub-segments. And the incremental RIDF or PSLC certificate purchase, that should not be there from, let's say, this quarter onwards, right? Is that the understanding?
So I'll clarify, Jay, on that. So fiscal 24, we are fully compliant. I mean, again, I just want to, for the sake of abundant transparency, there is a marginal shortfall in the NCF category, which is about 1.4% of the average net bank credit, which is nominal compared to some of the shortfalls we've had in the past. So which means that for fiscal 24, we will not get calls to place deposits with RIDF or NABARD in subsequent years, right? That does not mean that for fiscal 25, if I have to comply with PSL, we will not purchase PSLCs. So we will also purchase PSLCs to make sure that we are also complying with fiscal 25 requirements, such that the non-compliance does not trigger we do not get calls for our RIDF deposits in subsequent years after fiscal 25. So the compliance component typically is driven by three different ways. One is you purchase PSLCs, and you can buy for the entire quantum or you can buy for a limited quantum, but it is completely a function of what is your organic accretion of PSLCs. So purchase PSLCs, which we used with a total cost of about 377 crores in fiscal 24. The second is we also lend to MFIGs and let's say financial institutions who onward in turn lend to let's say some of the SMF or MCF category borrowers, right? So it's not a direct lending, but it is effectively a balance sheet that in turn will give you the PSL. It of course comes at a slightly lower yield than you would otherwise do organically. The third is you do it organically on the balance sheet. Again, there are two different models to do that. You can do it through a business correspondent or you do it directly through your own branches, right? Now, in the order of what I mentioned, which is PSLC, then you have lending to MFIGs and IFIs, then you have a BC model, and then you have a direct model. In the order that I mentioned is where you have from a cost of, let's say, ballpark 2.5% to an ROA accretive model of, let's say, anywhere between 3 to 4% is the spread that operates. And the endeavor is, as we kind of keep building our skill set in this particular space, we want to move away from having the contribution made from PSLCs to actually having more and more organic accretion coming in from our organic businesses, right? So that the cost that we are paying today for PSL compliance, which is about, let's say, 2.5%, that actually moves into not only recouping the cost, but into an ROA accretive model of about, let's say, 3 to 4%. So that's the journey that will play out also over the next few years. I hope I've answered that well.
Yeah, no, that is very, very clear. Thank you and all the very best.
Thank you.
Thank you. The next question is from the line of M.B. Mahesh from Kotak Securities. Please go ahead.
Niranjan, just this question on the security receipt. Can you just give us an update? What is the carrying value which got unwound in this financial year, and against that, what was it in terms of gains that you booked for the full year?
What was the carrying value that we unwound during the year, is what you're saying?
Yeah. Because I think when you started off this journey, you had about approximately about 5,000 crores, if I have the numbers right.
So let me. So I will just pull out the exact carrying value as of March 23. Give me a minute. But March 23, if I go back, Mahesh, our NNPA plus SR was cumulatively 2.4%. And against that 2.4%, the SR value was about 1.4%. And if I look at just 1 minute. So just bear with me. I'm just putting out the exact number. 1 second.
Yeah. And while you are answering this, if anyone else can answer, the provisions that we are carrying today, it's currently at about closer to 70% on the SR book today. How much more does it have to go up, or do you think this is more or less done here?
So Mahesh, to be honest, just from a coverage standpoint, we don't need to have a coverage on the security receipts, because we believe that the ultimate recovery actually is going to be more than that. The only reason we do end up carrying provisioning is because there is also a concurrent aging related provision requirement that keeps coming in, and depending on how we kind of use the redemption that we get, we ultimately use it for making sure that the burden of any aging related provision actually is zero. So just from a P&L impact standpoint, let me just answer that. So fiscal 24, if I look at a net level, the P&L benefit that we would have got is about 700 crores. okay, during the entire fiscal 24, and a bulk of that actually has come through in Q4 fiscal 24. And this is on account of the write back that we would have had, as well as the surplus that we would have recovered over the face value. So about a 740 crores of P&L write back is what we have got from, let's say, the security receipts. Going back to the question that you asked, we had about 1,700 crores of face value, which was, sorry, not face value, carrying value in our balance sheet as of March 31st, 2023. That's come down to about 1,250 crores.
Okay, perfect. Yeah. And given that you had classified these in category A, B, and C when you had announced this transaction, how has been the performance of this book? Because the expectation was that the recovery rate should be reasonably healthy on this particular portfolio given where it was sold at the point of sale. Those numbers still hold on?
So Mahesh, if we see the security receipt at the time of transaction, 45% of that security receipt has been resolved in 15 months. Okay? So I think that way we are seeing a very good progress. And the initial expectation was that the entire security receipt resolution would happen in a period of, say, around 4 to 5 years. So if we see the 15 months trajectory and 45% SRs have been resolved, I think the progress has been quite good.
Mahesh, if I can also add, so the carrying value that we have currently on these security receipts, as I mentioned, as of 31st March is about 1,250 crores. What we have is our rating agencies that effectively give us an estimate of what the recoveries would be. I'm not putting management estimates, or I'm not relying on what the ARC recovery estimates would be. But rating agencies ascribe a certain value, and that value is about 5,000 crores. Now, clearly, the bank will have its own estimates, and as Prashant mentioned, we do see a good run rate of recoveries, not only in terms of absolute recoveries, but also the percentage of recoveries that have actually been playing out. So I just wanted to make sure that, so there's a 250 crores of carrying value. The rating agencies have put out a recovery estimate of about 5,000 crores that will flow into the security receipt holder.
Okay, perfect. Thanks a lot, Niranjan, Prashant. Just one last question. Cost of funds seems to have stabilized this quarter, few of you. Are we, from the way you're seeing these numbers, you would say that they have kind of peaked out for you guys as well?
So Mahesh, I would say yes. TD rates, we have seen some uptick from a TD pricing, but to be honest, it also got offset by the mix on CA and SAR to some extent. So I would say nothing material that we also expect, at least as of now, on the ground, that will play out in the near term from a cost of funding perspective.
Perfect. Thanks.
Thank you. The next question is from the line of Srinivas, an individual investor. Please go ahead.
Yeah, good morning. My question is about acquisition of a microfinance business, which is, they're on the radar of Yes Bank. It has been there for quite some time. Any progress on that front? Do we see that forthcoming in this current financial year? Then second question is as Prashant sir mentioned, 3 years of continuous profitability. So what exactly is the kind of benefits which the bank is likely to see from government and PSU bodies? And the third question is what is the plan regarding the branch expansion? Whether the branches that we have added in the last 3 years or so, have they been contributing towards the operating leverage? Has it started kicking in, operating leverage?
So Srinivas, I think your first question in terms of MFI, I think we continue to explore that part, but as of now there is no progress. Okay, but let's see if we are able to do something in the current financial year. My comments regarding this is the third year of profitability. we become entitled to do the government business in terms of the tax collection and the empanelment with the central government and the other state government for doing the government business. And at the same time, for almost most of the PSUs, they deal with the banks for their businesses if you have the 3 years profitability. So I think this 3-year profitability would make us entitled to be qualified for empanelment with the central government as well as the different state governments to do the tax collection as well as the small saving scheme and their other business, which would be beneficial for the bank both in terms of fee as well as in terms of the low-cost deposits. Your third question was in terms of expansion. I think we are continuously expanding our branch network through branches as well as through the BCBO model. And we are seeing like the branches and these touch points are actually adding in terms of the both liabilities as well as fee income. So I think this branch expansion would continue to be our strategy going forward also.
Okay, thank you. My last question, actually, this 3-year profitability, has it improved our credit ratings so as to enable us to acquire a refinance from lending institutions, refinance which is a cost-effective source of funds? Have we been able to do that from institutions like NABARD?
No, so I would not be specifically commenting about NABARD, but definitely the third year of the continuous profitability and I think the momentum which we are seeing in our performance, we are quite hopeful that it should result into some rating upgrade. And whenever there is a rating upgrade, it also results into the lower cost of funding for the bank.
Okay, thank you.
Thank you. The next question is from the line of Chintan Shah from ICICI Securities. Please go ahead.
Yeah, hello. Good morning, sir. Thank you for the opportunity and congratulations on good set of numbers. Sir, I just had a question on LDR. So LDR now is around 85%. So this is almost at 5-6 years low. Even prior to the reconstruction, our LDR was higher than this. So I think even in the last quarter we mentioned that we are comfortable around 90%.
Mr. Shah, I'm sorry to interrupt. Sir, your audio is not clear.
Sorry, yeah.
Can you use your handset, please?
Yeah, ma'am. Yeah, sorry. Hello. Is this better now?
Yes, sir. Please continue. Thank you.
Yeah, sir, so my question was on LDR. So our LDR is around 85% now, which is almost at 5-6 years low. Even prior to the reconstruction, we had an LDR which was higher than the current one. So any qualitative comments on how could the LDR move from current levels? Even in the last quarter, I think we mentioned that we are comfortable with LDR around 90%. Yeah, so first question is on that. Yeah.
So Chintan, like last time also what we were saying, that we are comfortable with the LDR of less than 90%. Okay. So I think this trajectory or range between 85 to 90, depending on like what happens on some of the loan growth and the deposits, I think we are quite comfortable. But as a strategy, we would always like to have our deposit growth higher than the loan growth. Okay. So I think this range of 85 to 90 is quite comfortable for us.
Sure. So, sir, in that case, would we like to, if we are seeing surplus deposit inflow, then would we like to cut any of our deposit rates on the SAR side or on the TD side? Would that be a case?
No, I think naturally it would also be a function of what happens in the market and how our deposits are coming. But definitely endeavor of the bank is to continuously reduce our cost of deposit and cost of funding.
Sure, sir. That's it. Yeah, that's it from my side. Yeah. Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Prashant Kumar for closing comments. Over to you, sir.
Again, thank you all of you to join us for this call so early in the day and for your support. Thank you so much.
Thank you, members of the management. Ladies and gentlemen, on behalf of Yes Bank, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.